Hi everyone, I'm Radhika Bajaj. Today's video is about understanding that if your money is not invested, it's just idling away somewhere in the bank, in your wallet, even in your cupboard. It could be anywhere, but if it's just sitting somewhere without generating returns, it's actually losing its value. And that's because inflation eats into the purchasing power our money holds over a period of time. So in this video, we'll tell you how you can put your money to work and beat inflation by investing in mutual funds. Of course, before we move ahead, here's a quick request to you all to please hit the subscribe button to our channel and like this video if you haven't already. Thanks for that in advance. So now let me take you through what we will be covering in the video today. We'll talk about inflation's impact on consumers like you and I. We'll also speak about why inflation has been skyrocketing globally and in India. Then we'll find out how one can beat inflation, and finally we'll share why mutual funds can be the best bet for the average investor to get inflation beating results. So let's get started. You might have heard that a rupee today is worth more than a rupee tomorrow. In the current world, every other week the prices of most things are going up, but is our income going up at that rate too? Of course it's not. We simply accept this increasing mehengai, we adjust our budgets and try to move on. We usually don't plan to stay ahead of inflation, and let's understand how drastic it can actually be. For instance, in 1985, a 500-gram pack of butter used to cost around 6.5 rupees. Today the same packet costs 255 rupees. 1985 के वो 6.5 rupees are practically worth less today. That's the impact of inflation. Another instance that affects almost all citizens and businesses is, of course, oil prices. With 100 rupees in 1985, you could have bought 12.5 liters of petrol. With the same amount, you could have bought 2 liters of petrol in 2007. This year, 1 liter of petrol is hovering around 100 rupees a liter. With these examples, I hope you can understand that to prevent the loss of your money, just saving is actually not enough. We need to create money from money, else we are letting inflation steal it from us. Retail inflation hit an 8-year high of 7.79% in April 2022 this year. It pulled back slightly to 7.04% in May, and it could persist as a problem for many more months to come. Let's find out next what's actually pushing inflation higher. So there's a combination of multiple reasons that are behind the high inflation trajectory that we've been seeing. The first is that central banks all over the world had been slashing interest rates to encourage economic revival in a COVID-hit world economy. That's been starting to show its effect. A lot of money was poured in by the central banks by buying government long-term bonds. Now, the central banks printed and poured a lot of money into the market to keep the economy afloat. It succeeded in a way because an economic collapse was avoided, but it's given consumers a lot of money in their hands, which has led to a surge in demand once the lockdown and restrictions were actually entirely removed. And that has been leading to what we see today, inflation. Secondly, with the reopening of global economies, the demand for fuel has significantly increased, resulting in higher energy prices. This was further worsened by the Russia-Ukraine conflict that has impacted the supply of oil globally, resulting in skyrocketing of energy prices across the globe. Oil companies actually have been struggling to increase production at a pace fast enough to meet the surging demand. And as you know, when supply is low, the demand is high, prices shoot up. In India, of course, a heat wave and drought conditions earlier this year have resulted in lower production of vegetables and grains, which is why prices of kitchen items have also been soaring over recent months. Globally too, food prices have shot up since the Russia-Ukraine conflict has affected supply chains. Now that we have understood what inflation is and why we need to beat it, let's look into 4 different ways to beat inflation. Old wisdom is certainly gold, pun intended. For generations now, us Indians have invested in gold. It's a good inflation hedge because increase in gold prices and returns on it have been able to offset inflation historically. The demand for gold increases when inflation increases. According to a World Gold Council study, for every 1% increase in inflation, there is a 2.6% increase in gold demand. And as there is an increase in demand, it leads to increase in price. Another asset class that usually beats inflation, at least in India, is real estate. But of course, real estate investments require a significant amount of capital, and so very often it's the last option that the average investor looks towards. Moving on to the next option, let's talk about investing in inflation indexed bonds. These bonds are one of the most secure and effective ways to guard against inflation. This bond is unique in the way that it adjusts its principal amount to account for changes in inflation, and interest then is paid on the adjusted principal. But not many are aware about this product or understand the product in detail. Another way to get inflation beating results is investing directly into equity. Stock markets have outperformed inflation in the long run, but there are many ups and downs and volatile situations in the short term. And of course, all of us cannot be great stock pickers like Warren Buffett or Rakesh Jhunjhunwala. Choosing across these inflation-beating asset classes is not easy, and managing all of them directly is not always possible for an average investor. And that's where mutual funds come into the picture. Mutual funds are managed by professionals. They have tons of experience, and they are usually experts in their specific sectors. Let's now explore different mutual funds that can help you beat inflation. First on the list are gold mutual funds. These mutual funds are actually less expensive than gold, and you don't have to worry either about the purity of the gold or its safekeeping, unlike when you physically buy the yellow metal. The big advantage of gold mutual funds is also that you can start with a low amount and keep building as per your requirements in the long term. Next on our list are real estate mutual funds. A large part of these funds goes into investment in commercial and corporate properties, residential complexes, and agricultural land. Real estate mutual funds can invest in property directly or indirectly via real estate investment trusts. These are a great alternative to purchasing property and also highly liquid relative to actually buying real estate. Let's now talk about inflation indexed bond funds. In India, inflation indexed bonds are sold by the RBI. They are a good inflation hedge, and their principal amount increases along with inflation. However, the bond prices may fluctuate depending on the interest rate. Therefore, to be on the safer side, it is better for an average investor to take the mutual fund route to access these bonds. Finally, let's talk about equity mutual funds. Of course, investment in equity mutual funds can be considered high risk by many investors. But while all equity funds are exposed to market risk, how much risk you are actually taking will depend on the type of equity fund that you choose. Large cap funds, for example, that invest in well-established companies with sound fundamentals are considered the least risky, and they are likely to give you inflation-beating returns too. So you see, within mutual funds, there is a large variety of options to pick from if beating inflation is your target. Hope this information was actually useful to you, and if there are any other topics around mutual funds that you'd like us to cover, do drop that suggestion in the comments box. That's it for today. Thanks for watching. Happy investing.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.